Welcome back to another podcast and great episode where we talk about all things alternative assets here at the IRA Club. Your host, Ramez VP, and one of the things that we always have a hard time breaking down is when somebody does have an IRA or 401k and now they're looking to use a portion of their retirement dollars to invest in alternatives. Some people are not so much aware of the tax consequences. And we're really happy to have Adam Barr, CPA and partner with Miller Grossbard Advisors, to talk to us about the specific topic. Mr. Adam Barr is going to kind of break down the do's and the don'ts when it comes to this specific type of tax called UBIT or UDFI. But before we jump into all that and kind of break it down where a lot of our clients get very scared and weary. Is this the right move? Should I be doing this? I heard that this is a big red flag. It's actually one of the top 5 questions that we get here at the IRA Club. And, it's not that scary. I promise you. All right. If you know what you're getting yourself into. So without further ado, one of the resident experts in this field, Mr. Adam Barr, he's a licensed CPA and is a managing partner at Miller Grossbard Advisors. Is here to discuss this topic. So Adam, without further ado, please give us a quick introduction of who you are and how you got started. And we're just going to jump right into it.
Sure, Ramez. Thank you so much for having me. It's a pleasure to be here with you. As you stated, I'm a CPA here in Houston, Texas. One of the partners at Miller Grossbard Advisors. I've been in public practice for approximately 13 years. Primarily, what I work on is business tax and real estate tax. So we do a lot of work with owners of what we call small to medium-sized businesses, which is generally speaking, revenue from about 5 million to about 100 million and up from there. On tax planning, tax compliance, how do I meet my goals from both a business and a tax and accounting perspective? We do work on this UBTI issue. So this is something I accidentally became an expert in years back. And so I've kind of spoken about it on multiple occasions, and I have a sort of side area of my practice where we help IRA investors with these types of issues, but we're primarily business focused.
So me and you need to talk off subject because I think you would be also a great fit for our resource center for IRA Club SBS, Small Business Solutions, but that's another topic in its own.
Sure.
But you'll be so surprised, Adam, how many CPAs, lawyers will literally reach out to the IRA Club because we have an IRA Club member, right, that's invested in real estate, may have leveraged a property, and they're just like, wait a second, what is this UDFI or UBIT? Or So in your general sense, I know, although they're different, they're kind of interchangeable. If you could just give us a quick breakdown, what is the differences between UBIT and UDFI?
Of course, yeah. And I was surprised several years ago. I am no longer surprised. 98% of CPAs want nothing to do with this. So, it is something that people try to avoid dealing with, but it's not that scary, as you said. So the sort of the core subject here is UBIT, the Unrelated Business Income Tax, which is essentially, it's like a totally separate tax regime that applies to tax-exempt entities that engage in a business or have debt leveraged assets, right? UBTI, as opposed to UBIT, is unrelated business taxable income. So that's just like on your personal tax return. You have your taxable income, and then on that, you pay your tax. So UBTI is the income. UBTI is made up of 2 different categories. There's one category that's business income. So it's income from an operating trade or business. And then the other category is this term you mentioned, UDFI, Unrelated Debt Financed Income. And that would be income from any debt leveraged asset. And so if you have a tax-exempt organization that has either an operating business or income from a debt leveraged asset, it's likely subject to the Unrelated Business Income Tax. There's some nuance there we can talk about. But yes.
Awesome. So, one of the biggest things that we talk to about with our clients is doing your due diligence, right, on any alternative investments. These taxes implementations somewhat seem to be just like overlooked and it's just because nobody knows about them, as you well know.
Right.
What are some types of alternative investments if somebody uses their IRA dollars to invest? Just can you throw in a couple examples of what can trigger UBIT?
Yeah, I'll give you what can and what won't. I'll give you both if that's fine. So,
Awesome, please.
what normally would trigger unrelated business taxable income in the tax would be if you have income from a business or a debt leveraged asset. We'll break it down step by step. So, income from a business would be like if you invested in a pass-through entity, so something that's not a C corporation like Apple, right? But like an LLC partnership structure or something like that. And that investment is engaged in a business. And a business could be it owns a hotel. A business could be it owns a restaurant. A business could be any number of things where you're actually conducting business on a day-to-day basis. Like there's another example would be like a car dealership. I know a group that does those, and so on and so forth. That would all of the income from that activity would be unrelated business taxable income. And keep in mind in these types of partnership structures,
Yeah.
your IRA has income when the partnership earns the income, not when the partnership gives you the cash as a distribution of profit. So that's a common nuance that's missed, but we'll probably talk about that a little more later. On the UDFI side, unrelated debt financed income, it's literally anything that is an asset purchased with debt. The most common example being rental real estate. Like,
Yep.
for example, multifamily apartment buildings are a very, very common example. Normally, when you're buying an apartment building, that partnership will debt finance it. In other words, they borrow money to purchase the property. So to the extent that that property is debt leveraged, you would have unrelated debt financed income.
One of the things that I actually wanted to illustrate is that is probably our bread and butter here, Adam,
Yeah.
is the leverage side of it. We manage thousands of single family homes here where some of them do have leverage. One of the things that the example that I want to give is let's just say, right, you have an old employer 401k and you would like to roll it over to the IRA club because you have identified this investment opportunity. One of the things, Adam, that I like to educate our students on or members or our investors on is, and you may know this yourself, 99.9% of banks do not like to leverage against an IRA. That's number
Hmm.
one. So
Yep.
that's very hard to come by. But if you do happen to find a bank, right, that allows for that, and there's a great resource underneath a group of lenders that we personally deal with that we have worked with side by side. But one of the things that these lenders do not do is educate you on what Adam's talking about, UDFI, at all.
Right.
Why? Because at the end of the day, they just want the sale, right? They want to leverage the money out. And also, you know, leveraging might be a lot higher than where it's at currently, especially if it has to be structured. Number one, Adam, correct me if I'm wrong, it has to be structured as a non-recourse loan
Hmm.
if you are using IRA dollars. Number two is the rates are drastically high. I mean, I looked at a couple companies out there that were asking 11, even as high as
Yeah, it's
12%.
crazy.
So yeah, on a 15-year or 30-year arm. So just or 30-year fixed. So just be aware of those things before you jump into those. But um, if you don't mind, Adam, give us, our listeners, an example. Let's just say somebody doesn't realize that they're triggering UDFI or UBIT, right?
Right.
Mm. A lot of our clients ask, well, how's the IRS ever going to know? Is
Yeah,
that a question that you get often? Like,
it
so,
is.
and I'm just asking this out loud because we get this question quite often is, do you? Is this a question that pops up all the
Oh
time?
yeah. No, we get this question a lot. How would the IRS ever know? Well, in some cases, they would know quite easily. And in some cases, it might be harder to tell. In cases where they could tell quite easily, for example, let's say that you're investing in a syndicated LLC. So somebody
Yep.
puts together a group of investors to purchase, let's just say, an apartment building to make it obvious, to make it a really simple, common example.
Okay.
Well, every year that partnership issues K-1s to all of its investors, including the IRAs, and it'll say, okay, this K1 is going to, IRA Club FBO Joe Smith IRA, right? And they issue that to you, and they're required to get a unique EIN for your IRA and put it
Mhm.
on that K1. So they're telling the IRS when they file that partnership return with the K1s, hey, IRS, here's a K1 for this IRA. Here's this IRA's EIN. So the IRS could theoretically then look in their computer system and see, do they have a record of a tax return for that IRA, Form 990T, which we'll get into later.
Yeah.
And if not, then they could potentially go after the IRA about that. Now, have I ever seen that happen? Not yet, but there's a lot of evidence to me that the IRS is gearing up for this because that requirement for the unique EIN just started last year, so a year and a half ago, essentially. So this is something the IRS is paying attention to, and I think they're going to start pursuing more in the future.
Yeah, and I'm happy that you brought that up because that's what most people don't realize is well, we know from the big beautiful bill, right? Trump
Hmm.
announced a few weeks ago that he is now going to allow private equities, cryptos, real estate, whatever it is inside of your 401ks. So to your point, the IRS is going to gear up as more and more people get wind of this, of self-directing, of alternative assets. Be prepared. Like if you are planning on leveraging or using it in that manner that Adam just talked about, you will trigger this tax. Now, a question that I get often, Adam, is if I'm using my IRA dollars, right, and I am triggering, let's say UBIT or UDFI, most of our clients know that all expenses or anything that's related to the investment must come out of the IRA. Is this the same thing for UBIT or UDFI? Do the taxes need to be paid from the IRA? And what does
That's
that
correct.
process look like, the filing and all and
Yeah,
so forth?
great. So yes, the IRA is a separate taxpayer from the individual. Let's say that I had an IRA and it invested in one of these apartment deals. When I get that K1, that's a K1 for my IRA. My IRA files the tax return, my IRA pays the tax. Okay. If I paid that tax for my IRA, that's a deemed contribution to the IRA subject to contribution limits. And if I have an excess contribution or I'm not permitted to contribute, then I have a more complicated tax problem. So generally, you don't want that. You want to preserve enough liquidity in the IRA to pay the tax from the IRA. So the tax return for the IRA is Form 990T, 990-T, which is a tax return just for the IRA that reports
Mhm.
the IRA's UBTI, and the IRA files that return and then pays the tax.
One thing is is the due date just like the standard due date, like any business? And can somebody file an extension if they realize, like, oh man, I didn't realize that I just triggered this taxable event? Is that something that's possible? Can you file for an extension?
Yes. So Form 990T for an IRA or a 401k or retirement plan
Yeah.
is due on April 15th, and it can be extended until October 15th. Now, just like for your personal taxes, an extension is an extension of time to file the return, but it is not an extension of time to pay the tax. You do need to pay any tax that will be due with the extension in April in order to avoid late payment penalties.
So we're talking about taxes, as always with UDFI, UBIT, whatever the case may be. What are those tax impacts? How high can they be? How low can they be? Is it a one, like everybody comes up to me, Adam, and says, "Oh my God, I just triggered 37% tax hit." Is that the case? Or is it what's the breakdown for that is what I'm trying to ask.
In most cases that we see, the 37% tax rate doesn't apply most of the time.
Nice.
So it is the tax rates that are used for UBTI are the trust tax rates, which you can Google and look up. But essentially, they're graduated tax rates like 10, 25%, 37%. That 37%, you get to that when you're at like $15,000 of income for the year. So it is a very low ceiling, and you do get to the top tax rate really quickly. But the important thing to remember is that in a lot of these types of investments, especially in real estate,
Mhm.
you tend to have depreciation that offsets your operating income over the life of the property, and you're generally recognizing your taxable income as a capital gain when you sell the property. And in that case, the capital gains tax rate is 20%. And then there's some depreciation recapture at 25%. So you can think of it as maybe a blended 20, 22% tax rate. And then the one other thing that people often miss is that it's only on if it's UDFI that we're talking about,
Mhm.
it's really only on the debt leveraged portion. So if that property is only 60% leveraged, then you're only paying tax on 60% of that gain. So what I just said about tax rates was really primarily related to a debt leveraged asset. In terms of an operating business income is typically ordinary income. And generally, if you have an operating business, you might have some depreciation to help you out, but eventually you're probably going to have positive taxable income. So a lot of times if it's an operating business, and again, that might be something like a hotel or a restaurant or a laundromat or a gas station, I don't know, pick, right? Whatever's like an actual business that's doing something. You eventually get to the point where you have ordinary income being taxed at 37%, and you don't have the advantage of having a debt leveraged ratio reducing that. So in that type of situation, we have an alternative strategy that we recommend to basically reduce the effective tax rate by putting a C corporation into the structure to limit the tax rate to the 21% C corp tax rate. So that's,
Mhm.
if people are curious about that, that's something I can answer questions about. But that's a common strategy. So, typically if you plan it right and you have the right strategy and you know what you're investing in and all that, the tax rate's really more like 20 to 25% in the general case. 37% means you probably need to look at your structure and see if you can be doing it better.
100. I'm so happy you broke that down because I tell people, number one, we're talking about diversification here.
Yeah.
Be obsessed with the investment process.
Hmm.
Taxes always could be altered. I've never seen anybody pay the 37% UBIT tax as long as I've been here for almost a decade.
Hmm.
So it's rare to your point. Even our most sophisticated investors here at the IRA Club, compliance, is always a big issue, and that's one of our jobs and our fortes is to make sure it's IRS compliant. But what are some of the most common mistakes that you see when it comes to when somebody uses their IRA or 401k or any traditional retirement dollars when they trigger UBIT or UDFI? What are some of the most common mistakes that you see?
I want to clarify one point before I answer that question.
Please.
So we're talking about self-directed retirement plans, and I
Yes.
want to I want to distinguish between IRAs and between self-directed 401ks, okay?
Got it.
So an IRA is subject to UBTI if it has an ordinary business activity,
Yep.
and UDFI if it has a debt leveraged asset. For some reason that we'll never really know, Congress made the tax law such that a 401k only is subject to the unrelated business income tax if it has an operating business activity. It is not subject to the UDFI rules. So a 401k that invests, for example, in one of these apartment deals, that's a debt leveraged rental property, has actually no UBIT implications at all.
And to your point, we have no idea why. And that was actually one of the follow-up questions that I had is what are some of the ways that you could avoid, UBIT or UDFI?
Yeah.
Um, and this
We
is one of
yeah,
them is
correct.
is
Yeah.
the 401k. And I always tell people when we're having those discussions, Adam, if you qualify for a 401k, my team is always going to put you inside a 401k for obvious reasons, this being one of
Yeah.
them, right?
Right. Right.
The contribution limits are going to be drastically higher. We could set up profit sharing plans. You could borrow, up to $50,000, which by the way, we never recommend because it's hard enough to get money into these accounts.
Right.
But we understand life happens and everyone's goals and situations change quite often. But that is one of the ways to your point, and I'm so happy you brought that up, is the 401k is exempt from this specific tax. So
From
if you
UDFI.
yeah, from
Yes.
UDFI. So my question is, how does the next question I always get is how does one qualify for a 401k or solo 401k?
Fantastic. So I'll answer that question, and then I'll go back to your previous question. So how does one qualify for a self-directed 401k is you need to have either self-employment income, like you're an independent contractor for somebody and they pay you on a 1099 and you have that as your business income, or you have to have income from a profitable business activity. So, for example, maybe you have an S corporation that runs a business like a law practice or, really anything that's an operating business. What generally won't get you there is like, hey, I own 5 rental properties. That's my business income. Well, yes, I understand that that can be thought of as a business, but it's not a business for this purpose. It needs to be something that's like actually an operating business, or you need to be having self-employment income from like a 1099 gig or something like that, and that's generally what would qualify you to have a solo 401k. If you're an employee somewhere, like if you work for Google and you get a W-2 and that's kind of it, and you own a couple rental properties, like you don't really have any basis for having a solo 401k because you don't have a business activity or self-employment income. You asked basically in dealing with UBTI, UDFI, what are some commonly overlooked things and items.
Yeah.
One of them is what we've just been talking about, which is if you're going to invest in a debt leveraged asset and you have the opportunity to do that in a solo 401k instead of an IRA, you absolutely should do it because you're not going to have any tax impact at all when you make that investment in a solo 401k. Solo 401k would only be subject to tax if it's an ordinary business activity. Some other things that people often miss, especially if they are going to, for example, purchase a rental property in their IRA, and let's just say they're just buying some single family houses, not like investing into a syndicated fund. If people don't think, oh, I need to keep records. And maybe that sounds a little bit basic, but if you are going to buy a rental property in your IRA, you need to have very detailed records about all the
Mhm.
dollars coming in, all the dollars going out. You need to have your amortization table for the loan. You need to have your closing statement. You got to have all that stuff in a row because when it comes time to file the tax return, you're going to need all of that information. Yeah.
And that's, by the way, something that makes IRA Club so great is we actually do that paperwork
Oh,
for you.
wonderful.
So that's what we provide as your administrator to your CPA. So that's maybe why Adam would probably love us in that aspect alone. So
That's fantastic. I love that. That you guys, as far as I know, that makes you unique right now. So
yeah.
that's pretty
So
exciting.
we always recommend that you still reach out to your CPAs, your lawyers, or whoever it is that you're using. But we help with that process to some degree, especially with the title companies. Adam, what's another way that you could avoid UBIT? Because one of the things that we talk about a lot at the IRA Club is partnering. So if you don't qualify, let's say for a solo 401k, a self-directed solo 401k, most people don't realize another way to avoid UBIT is to use your retirement dollars and possibly your personal dollars. Partner that money together, and would that trigger UBIT or UDFI in that manner?
So I think what you're referring to is, for example, setting up an LLC that is owned partially by you and partially by your IRA. Is that
Correct.
right?
Correct.
So you can do that. You just have to be very careful to make sure that everything is always according to ownership percentages. Every time money goes into or comes out of that LLC,
Yep.
let's say you're your IRA and you own that LLC 50/50.
Yep.
Every time money goes in or out, it has to be 50/50. Because otherwise you might have what's called a prohibited transaction,
Correct.
where it's self-dealing if you buy or sell assets to your IRA or you make a loan to your IRA or your IRA pays you a salary. Those are all bad. We don't do those. Okay. Now, that would only avoid UBTI to the extent that you have a personal share of ownership in it.
Hmm.
And then you would be subject to regular tax, right, as an individual for your share of the ownership. So if there's a way to completely avoid UBTI with that structure, I'm not aware of it, but I'm curious to hear if you have any thoughts on that.
No, full disclosure, we have, like I said, we probably manage about 3,800 homes here at the IRA Club, give or
Yeah,
take, in the past 15 years. And there is a few of our clients that say, hey, what, I have inside of, let's just say an asset's 200,000, a single family home. And
yeah.
a lot of our clients will say, well, I'm 100,000 short inside of
I
my
know I know
IRA.
where you're going.
My wife has 100,000 inside of
Yeah.
her IRA. Can my IRA and her IRA partner together to buy the asset outright? To your point, to keep the paperwork clean, we say percentage in, percentage
Yep.
out.
Right.
So as long as that is down to the penny, and a lot of the times the property management companies that we're dealing with are going to do that anyways, and
Yep.
they'll divvy up the money on behalf of your IRAs. But that is another way to avoid, for example, UDFI.
Yes,
Um,
and just to clarify, in your example, the reason you avoid UDFI is because you're purchasing the property entirely in cash and you have no debt. So when you have a rental property with no debt, there is also no tax implication to the IRA because it's
Correct.
not debt financed income if there's no loan.
But I did like your point where you said the deduction that you may take from the IRA, that portion um, can be as a tax deduction can help offset the UDFI, as you mentioned earlier.
Can you clarify that? I'm not sure what you mean.
So one of the things that you brought up was, let's just say I buy an asset, it's valued at 200,000, 100,000 is coming from my IRA, and the other 100,000 is being leveraged.
Hmm.
Does that allow you to take a deduction, or repairs or anything of that nature? Could that be?
Oh, sure. So when you have a unrelated debt financed income,
Mhm.
it's not you deduct all of the relevant expenses to get to the bottom line. That's the item that you report on your IRA's tax return. So you have rental income, you subtract your insurance, property taxes, your interest expense, your depreciation, all of that stuff.
And the other thing that I always tell people is, and if you just want to learn more, just general information, if you go to IRAclub.com, our resource center, There is a great page that just goes and does a full breakdown and analysis. We have a lot of blogs on there. But Adam, if somebody wants to just learn more on your side, or maybe just needs a little bit more help, or if one of our IRA Club clients are listening, how can they reach out to you?
Yeah, of course. So our website, which I'm sure you'll put somewhere in the notes to the show or
Yeah.
whatever, is mgallp.com. And there's a contact us button on that page where you can put in some information and reach out to us. You can also email me directly if you'd like at abarr@mgallp.com. Those are generally the best ways to reach out. Always
Yeah.
happy to help with questions on self-directed IRAs and UBTI and stuff like that.
And you know, Adam, one of the things that you and I need to talk about is including you in one of our resources because you are so knowledgeable in this topic for IRA Club clients. But you know, if I was like my co-host to give final thoughts, right? If you were an IRA Club client, or if you're anybody interested in using their retirement dollars, in particular IRA dollars, because that's the subject that we're talking about. Any final thoughts or anything you would want somebody to know before they jump into that transaction?
Yes, definitely. So I always have the same final thought. And this is a final thought for IRA investors, 401k investors, people who are just regular investors, doesn't matter. Here's the thought. When you are comparing your investment options, you should consider what is my after-tax rate of return on this investment? Because that's always going to be what gets you to the best place over the long term. And as an example of what I mean, let's say that you have your IRA and you're comparing two different investment choices. Okay. Let's say that I can make a private loan from my IRA to somebody and I can charge them 10% interest. Well, because that's not a debt leveraged asset, it's not a business, I have no tax. So my after tax return is equal to my nominal return, which is 10%. Now, let's say I can also invest in a real estate deal that has an expected rate of return of, let's say, 20%, just as an example.
Hmm.
And you might say, well, I don't want to do that one because I'm going to pay tax on it and I don't want to pay tax. But if you really break it down, your effective tax rate on that investment at the end of the day after the property sells might be 15%, 20%, depends on the debt leverage ratio. You're still going to come out ahead if you get 20% return and you pay 20% in taxes, that's 4%, right? You're still net 16% return, which is still better than the 10%. So just because you have taxes in that situation doesn't mean that's not a better investment. So always look at what's my after-tax return on my investment.
I love Adam. I love that you said that because I try to explain to people, um, listen, you can't touch it anyways until you're 60, right?
Right.
So if you have access to those dollars, and we always, like, again, we preach diversification at the end of the day. And
Yes.
when you look at things decade by decade, right? You know what the market's going to always give you, but real estate always outshines long term the potential or the opportunities of what you were talking about, those 16% returns, you know, the appreciation, the cash flow will always be there right back. And remember, the icing on the cake is the the tax um uh breakdown of what we were just talking about. Is you're always going to outwin what you're making, your 401k is making, let's say, with your current employer's 401k.
Yeah.
So keep that in mind always, right? At the end of the day, it's just playing with your money, having the right people in front of you to help guide you. For example, Adam, right here. So you know, those are the things that I want you to be aware of, and just have conversations with each other as you're listening to this. Reach out to Adam, his team. They're fantastic. If you just want to learn more about what it is that we do and our podcast, always visit us at IRA Club /podcast. And there's a great resource center on our website about this topic. And we'll make sure that you have access to Adam and his team, just if you have any general information that you would just like to go over. But Adam, thank you so much for actually just taking the time and just breaking it down and just keep it very simple for people to understand. And I'm sure there's some people that have their eyes are like, wait, what are we talking about? With their eyes rolled up. But that's the point of these podcasts, is to educate you on what's out there, what's available, And until next time, Adam, I would love to have you again in the near future, and we can kind of, have another topic or another go around at something else that we could, break down. Thanks, buddy.
Yeah, Ramez, I would love that. I'll thank you so much for having me. I'll see you next time. All right.
Until next time, bud.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.